sometime in the mid-1970s, something broke. It didn't make the front page. There were no riots, no press conference, just a quiet statistical shift that almost nobody noticed at the time. And almost everybody is still paying for today. Here's what happened. American workers got significantly more productive. They built more, made more, sold more, created more value per hour than any generation before them. And then they waited for their paychecks to reflect that. They're still waiting. According to data from the Economic Policy Institute, worker productivity in the United States has grown roughly 62% since 1979. Wages for the typical worker, about 17% over the same period. That gap isn't a rounding error. It's not a blip in the data. It's the central economic story of the last 50 years.
How
And
was the
somehow,
game last
it barely
night?
comes
It was
up in
great.
the
We won in
conversations
overtime.
most people have about
Nice.
money.
We should go
So
sometime.
today, we're
Let's
going
take
to
this
take
apart
that
to see how the
story
economy
apart.
works.
Not
By
with
examining
anger,
these
not
gears,
with
we can understand the
politics,
flow of money.
just with the clearest explanation I can give you of what actually happened, and why understanding it might be the most financially important thing you do this year. The promise that used to hold. For most of the 20th century, there was an implicit contract baked into the American economy. It went something like this. If the country gets richer, you get richer. Work hard, add value, and the system will reward you proportionally. It wasn't a legal guarantee. There was no document to sign, but it was real. You could see it in the data. From roughly 1945 through 1975, wages and productivity moved together, almost in lockstep. When companies made more money because workers were more efficient, those workers saw the gains in their paychecks. The deal held. Not perfectly, not for everyone equally, but directionally, it was true. If your father worked a factory floor in 1955, he could reasonably expect that 10 years of solid work would buy him a house, a car, a few weeks of vacation, maybe some savings. The economy wasn't just growing in theory, it was growing into people's lives. Then the 1970s arrived, and everything shifted. Where the money went. The standard explanation you'll hear is simple. Globalization and technology changed the game. Workers in other countries could do the same jobs cheaper. Machines started replacing human labor. The demand for certain skills collapsed. Wages fell because supply went up and demand went down. Basic economics. That's not wrong, but it's incomplete. Because here's the thing, the money didn't disappear. Productivity kept rising. Corporate profits kept growing. GDP kept expanding. The economy didn't stop working. It just stopped distributing its gains the way it used to. So where did the money go? 3 places, mostly. And each one deserves its own explanation. The first is shareholder primacy. In the early 1980s, a quiet revolution happened in how corporations understood their own purpose. The dominant idea before that was roughly, a company exists to serve its employees, its customers, its community, and its shareholders. In some balance. Then came a wave of economic thinking, most famously associated with the economist Milton Friedman, that argued for something sharper. The only real responsibility of a company is to maximize returns for its shareholders. Everything else is a distraction. That idea didn't just become academic theory. It became board policy. It became executive compensation structure. It became the dominant operating logic of American business. The consequences were predictable once you understand the incentive. If the measure of your success is the stock price, you cut anything that doesn't move the stock price. And labor, wages, benefits, headcount, is always on that list. The second shift is where executive pay went. Between 1978 and 2020, CEO compensation grew by roughly 1,322% according to EPI research. The average worker's pay? About 18% over the same period. A lot of that executive compensation came through stock options, which meant executives now had a direct personal financial interest in the same thing shareholders wanted. Higher stock price, lower labor costs, stronger quarterly numbers. The incentive loop closed. Everyone at the top was pulling in the same direction. And the third piece is the collapse of worker bargaining power. In 1954, roughly 35% of American private sector workers were members of a union. By the early 2020s, that number had fallen to around 6%. That's not a slight decline. That's the near total dismantling of the primary institutional mechanism. Workers had to negotiate their share of the pie. Unions weren't perfect. They had corruption problems, rigidity problems, and legitimate critics on both sides of the political spectrum. But whatever you think of them ideologically, they functioned as a counterweight. Remove the counterweight, and you stop being surprised when the scale tips. The psychological trap. Here's where it gets personal. Most people experiencing wage stagnation don't think of it as a structural economic problem. They think of it as a personal one. They ask themselves, what am I doing wrong? Why am I not getting promoted faster? Do I need another certification? Should I be networking more? Am I at the wrong company? This isn't an accident. The cultural framing around wages has been, for decades, almost entirely individualized. Wages are treated as a personal performance score. If you earn more, you earned it. If you earn less, you didn't. But wages are not just individual performance scores. They are negotiated outcomes in a system with rules, power dynamics, and structures that existed long before you walked into your first job interview. Think about it this way. Imagine two workers at the same company. Same skills, same output, same hours, same results. One works in 1965. The other works today. The one in 1965 earns meaningfully more in real terms, has better benefits, and has more job security, not because of anything personal, but because of the structural environment they're operating inside. The system shapes the outcome. The individual operates within it. And when the system changes in ways that systematically suppress wages, telling every worker to simply outperform the system is not a solution. It's a distraction. Now, and this part matters, this doesn't mean individual effort is irrelevant. It's not. The workers who do rise, who do earn significantly more over time, tend to do specific things. They develop rare and valued skills. They move between companies strategically. They negotiate aggressively. They position themselves where labor demand is highest. Individual decisions still matter, but understanding the structural picture changes what decisions make sense. It changes where you point your energy. The inflation illusion. There's another layer here that rarely gets discussed honestly. Even when nominal wages, the actual dollar number on your paycheck, do increase, the real picture is often far less encouraging once you adjust for what economists call inflation. The official inflation measure most people reference is the Consumer Price Index, which tracks a broad basket of goods and services. But here's the problem. The things that tend to consume the most of an average household's income, housing, healthcare, education, childcare, have inflated far faster than the headline CPI number. Since 1980, college tuition has increased by roughly 1,200% in inflation-adjusted terms. Housing prices in major metropolitan areas have outpaced wage growth by substantial margins for decades. Healthcare costs have compounded in ways that have steadily consumed a larger share of total compensation, even as headline wages crept upward. So the situation is this. A worker may get a 3% raise, see a headline inflation number of 2.5%, and technically be told they've gained. But if their rent went up 7% and their health insurance premium rose 8%, they are concretely worse off, and the official numbers simply don't capture that. This is why so many people feel financially squeezed in ways that the published data doesn't seem to validate. Because the published data isn't measuring what they're actually spending money on. What the future looks like. Let's be direct about where this is headed. The forces compressing wages haven't disappeared. In some ways, they're intensifying. Automation is no longer just a threat to manufacturing jobs. It's beginning to affect knowledge work, creative work, legal work, financial analysis. The technology displacement that used to hit factory floors is now arriving in office buildings. The question isn't whether AI and automation will continue to increase productivity. They will. The same question that's been open since the 1970s, is who captures the gains. And there are real reasons to think that question could be answered differently going forward than it has been for the past 5 decades. Labor markets in many sectors are tighter than they've been in a generation. Workers in certain industries have demonstrated, through the post-pandemic period, that collective action still produces results when the conditions are right. Some of the largest wage gains in recent memory went to the workers at the bottom of the income distribution, partly through minimum wage legislation, partly through a genuinely competitive labor market for lower skill roles. None of that means the structural problem is solved. It isn't. But it does mean the picture isn't static. What you can actually do. Let me give you the honest version of practical advice here. Not the version that pretends one productivity hack will overcome 50 years of structural drift. The first thing is to negotiate. This sounds obvious, but research consistently shows that the single highest return activity most workers can engage in terms of lifetime earnings, is negotiating their salary at hire and at each subsequent review. The raise that doesn't happen because you didn't ask compounds in both directions, against you when it's missing, and for you when it's captured. Most people dramatically underestimate how much room there is in most salary conversations. The second is to develop skills that sit in the overlap between high demand and limited supply. The workers who've seen the strongest real wage growth over the past few decades have been those whose skills became more valuable as the economy changed, not less. This isn't a call to chase whatever's currently trending. It's a call to think seriously about where skill scarcity is heading, not where it's been. The third is to understand that loyalty to an employer has a different return profile than it once did. The decades when staying at one company for 30 years was the optimal career strategy are largely behind us. In many fields, the data is clear. Workers who change employers strategically tend to capture significantly higher wage growth over time than those who rely on internal promotion cycles. And the fourth, perhaps the most underrated, is to build income streams that don't depend on selling your time. Not because everyone should be an entrepreneur, most people shouldn't be, but because a paycheck-only financial position leaves you entirely dependent on one side of the structural imbalance we've been describing. Any capital income, any ownership stake, any asset that compounds on its own, these shift the math. None of this is a complete answer, because a complete answer to a structural problem requires structural change in policy, in corporate governance, in how we think about the relationship between productivity and compensation. Those changes happen slowly, unevenly, and often not at all. Here's what I want you to take from this. If you've spent years doing everything right, working hard, improving your skills, showing up consistently, and your paycheck still doesn't seem to reflect it, you are not imagining things. You are not failing. You are operating inside a system that has been systematically redirecting the fruits of your labor for decades. Understanding that clearly doesn't make the system less frustrating. But it does make you less likely to misdiagnose the problem. And misdiagnosis is expensive. The workers who navigate this environment best aren't the ones who work the hardest in the traditional sense. They're the ones who understand the rules of the actual game being played, not the one they were told was being played. Productivity went up, wages didn't. That's not a personal failure. It's a design feature. And once you see it, you can't unsee it.